Hello, my name is David Hernandez. I'm a senior research analyst at Marquette, and I cover non-U.S. equities.
Hi, my name is Samantha Grant, and I'm a senior research analyst at Marquette covering U.S. equities.
And we are going to discuss the topic U.S. against the world, should investors still own international stocks? The agenda is focused on three categories. We're going to talk about performance, the last 10 years and beyond. Second, we'll answer the question of whether there is still a diversification benefit to owning international stocks. And lastly, we'll take our crystal ball and discuss what investors can expect from U.S. and non-U.S. equities in the future. The number one reason why investors question their non-U.S. equity allocation is performance. The last 10 years, Samantha Grant and her U.S. equities have kicked my asset class, non-U.S. equities. Since December 2009, the S&P 500 is up 221%. In comparison, emerging market equities are up a measly 26%. International large cap stocks haven't done much better, up only 53%. As a result of this wide gap in performance, you'll often hear the term lost decade to describe the last 10 years for non-U.S. equities. So the question is, why have U.S. equities outperformed? And Sam, you probably beat me purely because of luck, right?
No, David, it wasn't luck at all, but good old fundamentals. U.S. companies came out of the global financial crisis in a much better position than their non-U.S. peers, mainly due to supportive monetary and fiscal policies. However, there is another F word that made performance spectacular: FANG. Facebook, Apple, Amazon, Netflix, and Google have grown and dominated over this time period. FANG has also spawned other companies, products, and services that we could barely comprehend 10 years ago. This has led to 67% higher earnings growth for the S&P 500 over our friends in Europe and Japan, and 58% higher profitability over emerging markets.
So of course, Sam is right. It wasn't luck, it was fundamentals. That was the reason for U.S. equities outperforming. But let's go back in time. Let's go back to a time when my asset class was on top and beloved by all investors. This is the 2000s. Between December 1999 and December 2009, non-U.S. equities were the place to be. Emerging markets returned 154%, while the S&P 500 returned negative 9%. So if you want to talk about a lost decade, Sam, that certainly was a lost decade for the S&P 500. Similar to what we've seen this period, fundamentals are a key reason for the outperformance. While profitability levels across all asset classes were pretty much even here on the right-hand side, earnings growth for non-U.S. equities were much stronger. For example, emerging market equities saw their earnings per share grow by over 500% before the global financial crisis. International large cap stocks grew by over 300%.
So since you want to bring up the past, David,
Yes.
Let's go back.
Let's do it.
Way back. There have been several periods of outperformance for each region since the 1970s. The U.S. outperformed over most of the 1990s due to the adoption of new technologies and high productivity growth, while non-U.S. stocks lagged from the fallout of the Asian financial crisis. However, in the 1980s, non-U.S. stocks outperformed by almost 200%, in large part to the rise of Japanese equities. The point is, 1 + 1 = 2, and each region has its time to shine. And just in case anyone here thinks that they can anticipate these trends, you can't. No one can. The performance on the last slide seems so smooth because we evaluated 3-year rolling returns, but there's a lot of variation from year to year. In some years, the U.S. was at the top, and in other years, non-U.S. stocks were at the top. For example, if you had written off emerging markets after their 53% decline in 2008, you would have missed the 79% rebound in 2009. Or if you were just convinced that the U.S. was doomed forever after underperforming in the 2000s, you would have missed out on the outperformance post the global financial crisis. So the only way you can make sure that you don't miss out on outperformance in either region is to always be diversified, diversified, diversified. But diversification does not work every day, every month, or even every year. The number one question we get from clients is, why do I need to invest outside of the US when US corporations are multinational and thus diversified? Yes, it's true US companies are multinational, but if you look at the revenue sources for the S&P 500 in the first column, you can see that 60% of revenues come from within the United States. Surprisingly, China is the only meaningful non-US revenue exposure. But the tables are turned in non-US markets. The MSCI EAFE and emerging markets indices are much more diversified by revenue sources, leading to just more at-bats from a country perspective. There is no single country exposure that accounts for over 50% of revenues in either index. Digging deeper into the S&P 500, you'll see that technology companies have the highest exposure to international revenues. So if non-US stocks start to outperform, many of the domestic companies listed here should benefit.
Sam, I'd like to take this time to remind you how a heavy concentrated IT position can impact a portfolio. Here we're looking at the NASDAQ. From its peak in 2000, it fell by 75% over the next 2.5 years. And to that point, non-US equity allocations help diversify portfolios not only based on revenue exposure and not only on an individual stock basis, but also as it relates to sector allocation. As an example, the S&P 500 has over 20% exposure to information technology. This is one of the reasons why that index has performed so well, because this sector has performed so well. In comparison, International Large Cap, or the MSCI EAFE index, only has 6% exposure to IT. In general, non-US equities have more exposure to cyclical sectors like energy, financials, and materials, and thus provide more diversification at the overall portfolio level.
So now it's time for a game. So far, we have focused on the differences between the US and non-US, but there are plenty of similarities too. We want to know if you can correctly answer the following questions. So, first up is the snack category. Yes, there are two Kit Kats, a European version sold by Nestle and an American version sold by Hershey. Which one do you think gives us the best break? The answer is Nestle. Nestle is the largest non-US company and the 7th largest company in the world. Some of their brands include Gerber, Purina, and Haagen-Dazs. Next up is the car category. Okay, so we know Toyota is the largest auto manufacturer in the world and has been for years. But who is second best? Is it GM with its best-selling pickups or Volkswagen with the Beetle, which actually won't be made anymore? The answer is Volkswagen. Even after the car emission scandal, Volkswagen and its brands of Audi, Porsche, etc. is still larger than GM. And GM isn't even number 3. Hyundai, a South Korean maker, holds the number 3 spot. Last up, the most contested question of them all. Who makes the best phone? I'm Team Samsung.
I'm iPhone.
So, while Apple is the 2nd largest company in the world, it is also the 3rd largest handset maker, behind Samsung and Huawei. So maybe we'll call this a tie.
Sam, these companies are excellent examples of multinational corporations that sell to consumers across the world. Over the last 20 years, global trade has increased, and we've seen a corresponding increase to foreign revenue exposure for the S&P 500, now hovering around 40%. As a result, we've also seen longer-term correlations between US and non-US stocks rise the last 20 years. Now, correlations are a mathematical calculation that tells us about diversification. A number closer to 1 indicates less diversification. A number closer to 0 indicates more diversification. Back in the 70s and 80s, non-US equities had an average correlation to US equities of 0.5 over rolling 5-year periods, so pretty good diversification benefit. Over the last 20 years, globalization has led to a trend of longer-term correlations rising, So some of that diversification benefit has been lost. But if we look at shorter term correlations, in this case rolling 1 year, you can see that there is more variability on a year-to-year basis. For example, between 2016 and 2017, the correlation between non-US and US stocks was actually negative. So there are years where the diversification benefit is higher. Still, at Marquette, we're mindful of the longer term trend, and for this reason, we think it's important to diversify your non-US equity exposure. This means consider allocating to international small caps, to emerging markets, as these are asset classes that have a lower correlation to US equities and can help improve the overall diversification profile.
So far, we've given you a historical perspective of US and non-US performance and some of the characteristics of each region. But we know you are more interested in what this means for future returns. So I'll turn it over to David for one last history quiz.
Which of these 5 major global economies holds the record for longest economic expansion post-World War II? The US ranks 5th on this list behind Canada, the United Kingdom, Japan, and Australia. Australia takes the title, they hold the record, they wear the championship belt for longest expansion post-World War II, and they're currently at 28 years. This country navigated the dot-com bubble, navigated the global financial crisis, and they did this through effective monetary policy, effective fiscal policy, and a lot of luck. They were huge beneficiaries of the Chinese boom as they supplied commodities like iron ore and coal to China over the last 20 years.
Speaking of the longest economic expansions, you will notice that the longest expansions have taken place in a time of expanding global trade, but this dynamic may shift towards protectionism over the short term. Fortunately for domestic equities, exports aren't a huge component of GDP. On the flip side, global trade accounts for a meaningful percentage of GDP outside of the US, with emerging markets seemingly at more risk if trade dynamics worsen. But remember, the MSCI EAFE and emerging markets indices are more diversified by revenues. In the interim, some non-US countries have strengthened their own trade agreements, like the Trans-Pacific Partnership, which the US is not even a part of. This may mitigate the effects of a more inward US. The trade war between the US and China has also impacted global growth, and our long expansion is now in a precarious place. The US yield curve is inverted at the short end, the Fed is cutting rates, the German curve is totally underwater, and the ECB has restarted QE. Typically, these actions precede recessionary environments. So we examine what the performance of each asset class would look like after the yield curve inverts.
And Sam, how did my asset class do in our analysis?
Annoyingly, David, non-US equities actually fared pretty well.
Nice.
But recessions do not last forever. Equities are positive most of the time, and one of the best fundamentals that we look to is GDP growth. The US had high GDP growth 20 and 30 years ago, but that growth has moderated to between 0 and 3% over the last decade, and is expected to stay in that range for the foreseeable future. Many emerging markets are expected to have GDP growth in excess of 3%, which is represented by the bright blue and green. Regardless, David, the US is still number one. We have the world's largest economy and the largest and most dynamic companies in the world.
Sam, that's true. The US is number one, largest economy in the globe. They're also the largest country in the global equity index. They currently make up 55% based on market capitalization. And this is the largest it's been over the last 30 years. So can we expect this trend to continue in the future? Now, another interesting trend that many clients have heard us discuss is the public equity market in the United States is shrinking as private companies are staying private longer. So while the US makes up 55% of the global equity index based on market capitalization, it only makes up 28% based on number of names. So excluding non-U.S. equities vastly reduces an investor's opportunity set. Now, I was at a client meeting earlier this year, and one of our clients had an interesting analogy that I hadn't heard of. This client compared investing to hockey. Now, I grew up in Texas, so I know a lot about football. I don't know much about hockey, but this idea still made sense. The client quoted Wayne Gretzky and said, in hockey, you don't skate to where the puck is, you skate to where the puck's going to be. And over the next 10 years, experts believe the puck is going to be outside the United States. Here we're looking at 10-year forecasts from investment consultants and investment managers. The forecasts have international large cap stocks outperforming U.S. equities by 1% annualized over 10 years, and emerging markets are forecasted to outperform by 2.6%. Now, these are forecasts, and this doesn't mean that we should go out and sell all our U.S. equities and load up on non-U.S. equities. But we do think that this serves as another reason why investors should stay patient and continue to own international stocks.
In conclusion, the relative performance of domestic and international stocks will vary over time. The U.S. is outperforming now, but eventually the tide will turn, as it always does. Second, despite increased globalization, non-U.S. equities are still diversifiers due to different sector and country exposures, and simply, there are just a larger number of investable opportunities outside of the United States.
And finally, experts forecast non-U.S. equities to outperform U.S. equities over the next 10 years. And we think this serves as another reason why investors should stay patient and continue to own international stocks. We want to thank everyone for their time.